Two Canadian investors. Same $10,000. Same starting day. Same 20 years. The first investor does what most income-focused investors do. They sort the dividend stock list by yield, find the highest number that looks credible, and invest. Their stock yields 7%. In year one, they collect $700 in dividend income. The second investor does something that looks worse on paper. They choose a stock yielding 4%. In year one, they collect $400, $300 less than the first investor. Objectively, lower income. 20 years later, both investors check their portfolios. The first investor, the 7% yield, is generating approximately $3,688 per year in dividend income. The portfolio is worth approximately $57,500. The second investor, the 4% yield, is generating approximately $16,067 per year in dividend income. The portfolio is worth approximately $159,000. The investor who chose the lower yield is collecting 4.4 times more income from the same original $10,000. Their portfolio is worth 2.8 times more, and the income gap is widening every single year. The difference was not luck, not better stock picking, not market timing. It was one thing. The first investor chased the yield. The second investor chased the growth. This is the most important concept in dividend investing that most Canadian income investors have never properly understood. And this video proves it with 20 years of math. Before the numbers, the concept. Because the 20-year comparison is so counterintuitive that it helps to understand the mechanism before seeing the result. Strategy A. High yield, no growth. The investor buys a stock yielding 7%. Year one income, $700 on $10,000. The dividend is large. But here is the problem. If the company is paying out 7% of its market value every year as a dividend, and the business is not growing, the dividend itself is not growing. The investor collects $700 this year. They will collect approximately $700 next year, and the year after, and the year after that. Meanwhile, the stock price barely moves, because a company not growing its earnings cannot grow its share price meaningfully. The investor owns a fixed income stream on a stagnant asset. Strategy B. Lower yield, consistent growth. The investor buys a stock yielding 4%. Year one income, $400. But this company has a track record of raising its dividend every year, at approximately 6% annually. That means the income is not $400 next year. It is $424. And the year after, $450. And so on. At 6% annual growth, the Rule of 72 tells us the dividend income doubles in approximately 12 years. So, by year 12, the investor who started with $400 is now collecting $800 from the original investment. By year 20, the income has grown to $16,067. The mechanism. The first investor owns a snapshot. The second investor owns a compounding machine. Both feel similar at year 1. They are completely different by year 10. Why this happens in practice. A company paying 7% of its market value as a dividend every year is typically a company distributing most of what it earns. There is little retained earnings left for investment, acquisition, or expansion. The business does not grow because the capital is going out the door as dividends. A company paying 4% has retained a meaningful portion of earnings. It reinvests in the business. The business grows. Growing earnings support growing dividends. Growing dividends attract capital. The stock price rises. which means even DRIP reinvested dividends are buying into a more valuable asset each year. 3 strategies, all starting with $10,000. All with DRIP reinvestment. Every dividend buying more shares. Those shares generating more dividends. 20 years. Strategy A, 7% yield, 0% dividend growth, 2% price appreciation. Think of this as a mature high-yield stock in a competitive or declining industry. The yield attracts income-focused investors. The business is not shrinking, but it is not growing meaningfully either. The dividend is large relative to earnings, leaving little for reinvestment. Year 1 income, $700. Year 10, $1,538. Year 20, $3,688. Final portfolio value, $57,501. Total dividends received over 20 years, $36,380. Strategy B, 4% yield, 6% annual dividend growth, 7% price appreciation. Think of this as a quality Canadian dividend grower. Fortis, Canadian Natural Resources, Enbridge, companies with long track records of raising dividends annually because their underlying businesses generate growing free cash flow. Year 1 income, $400. Year 8, $1,341. The crossover point where income exceeds Strategy A. Year 10, $1,945. Already $407 ahead of Strategy A. Year 15, $5,269. More than double Strategy A. Year 20, $16,067. Final portfolio value, $159,241. Total dividends over 20 years, $81,603. Strategy C, 3.5% yield, 8% annual dividend growth, 9% price appreciation. Think of this as a high-quality dividend compounder. Royal Bank, Toromont, Couche-Tard. Lower starting yield than Strategy B, faster growth rate, stronger business fundamentals. Year 1 income, $350. Year 10, $2,328. Year 20, $31,174. Final portfolio value, $258,939. Total dividends over 20 years, $131,054. The verdict at 20 years. The 7% high-yield investor collects $3,688 per year and owns $57,501. The 4% dividend growth investor collects $16,067 per year and owns $159,241. The 3.5% strong growth investor collects $31,174 per year and owns $258,939. All from the same $10,000. All over 20 years. The starting yield was the worst predictor of the outcome. The dividend growth rate was the best predictor. Here is the vault. The single number that tells you whether a high dividend is genuinely attractive or a trap about to cost you your income overnight. That number is the payout ratio. The payout ratio is the percentage of a company's earnings that is paid out as dividends. A company earning $1 per share and paying 60 cents per share in dividends has a 60% payout ratio. A company earning $1 and paying $1.19 is paying out more than it earns. That last scenario, paying out more than is earned, is not sustainable. A company cannot indefinitely distribute income it does not generate. Something has to give. And what gives is always the dividend. The payout ratio thresholds, by industry. Payout ratios are not one-size-fits-all. Regulated utilities like Fortis can sustainably pay 70 to 80% because their earnings are government-approved and highly predictable. Banks like Royal Bank operate at 40 to 50%, healthy, with significant room to grow. Industrials like Toromont at 32% are extremely conservative. The dividend could double and still be covered. Pipelines like Enbridge at 68% are sustainable because fee-based cash flows are reliable. The danger zone, above 85 to 90% for most companies. Above 100%, a company is paying dividends from reserves or debt, not from earnings. This is not an investment. It is a countdown. The BCE cautionary tale. In 2023, BCE, Canada's largest telecommunications company, was yielding approximately 8.9%. Canadians saw that number and bought it as an income stock. Financial media covered it regularly as an attractive high-yield opportunity. The payout ratio in 2023, approximately 119%. BCE was paying out $1.19 in dividends for every $1 it earned. The business was under pressure from rising capital expenditure requirements for network modernization and increasing competition. The high yield was not a signal of generosity. It was a warning light. In 2024, BCE announced a dividend cut of approximately 57%. The dividend fell from approximately $4.09 per share to $1.75 per share. A Canadian investor holding $10,000 of BCE saw their annual income drop from approximately $890 to approximately $380 overnight. Simultaneously, the stock price fell significantly on the announcement. The 8.9% yield was not income. It was a signal that the income was unsustainable. The payout ratio said so clearly, before the cut happened. The filter. Before buying any high-yield dividend stock, look up the payout ratio. If it is above 85 to 90% for a non-utility company, ask why the company is paying out that much. If it is above 100%, it is a countdown, not an investment. There is a concept that transforms the way dividend growth investors think about their portfolios. It is called yield on cost, and once you understand it, you will never look at current yield the same way again. Yield on cost is simple. It is the dividend income you earn as a percentage of what you originally paid for the shares, not the current price. The Fortis example, in approximately 2005, Fortis was trading at around $20 per share. The annual dividend at that time was approximately 60 cents per share. Yield on cost at purchase, approximately 3%. Today, in 2026, Fortis's annual dividend is approximately $2.36 per share. The stock trades at approximately $60 per share. The current yield for a new investor, buying today, approximately 4%. But for the investor who bought at $20 in 2005 and held, their yield on cost is $2.36, divided by $20 equals 11.8%. Nearly 12% on their original investment. From a stock that appears to yield only 4% to anyone looking at the current price. This is the power of dividend growth over time. The yield on cost of a dividend grower held for 20 years is dramatically higher than the current yield on any given day. The dividend grew. The cost basis did not. What this means for how to evaluate dividend stocks. When you look at a dividend stock yielding 4% today, the question is not, is 4% enough income? The question is, what will this 4% become in 10 years, in 15, in 20? Fortis at 4%, with 5% plus annual growth, becomes approximately 6.5% on your cost basis in 10 years and approximately 10% plus in 20 years. A stock at 7% with no growth remains 7% in 20 years. In nominal terms. In real purchasing power terms, it has lost significant ground to inflation. The Rule of 72 applied to dividend income, at 6% annual dividend growth. Income doubles in 12 years, at 8%. Doubles in 9 years, at 10%. Doubles in just 7 years. This is the mechanism behind Strategy C producing $31,174 in year 20 from a $10,000 investment starting at $350 per year. The dividend doubled roughly every 9 years. 3 doublings over 20 years at 8% growth. $350 to $700 to $1,400 to $2,800. And then, with DRIP reinvestment compounding the share count, the final income exceeds $31,000. The 20-year math is clear. Dividend growth beats high yield by a margin that is not close. The payout ratio is the filter that separates the genuine growers from the traps. Yield on cost is the lens that makes the patient investor's long-term outcome visible. Here is how to apply all of it, specifically to the Canadian market in 2026. The Canadian Dividend Grower Screen. When evaluating any Canadian dividend stock, run it through 5 questions in order. 1. What is the payout ratio? Below 60% for non-utilities, the company has substantial room to keep raising. 60% to 80% for regulated utilities. Sustainable. Above 85% to 90% for any non-utility. Investigate why before buying. 2. How many consecutive years of dividend increases? 10 years or more demonstrates the company has maintained and grown its dividend through at least one full economic cycle. 50-plus years, like Fortis, demonstrates something more extraordinary. 3. What is the dividend growth rate over the past 5 years? This is the engine. A company growing its dividend at 8% annually is doubling your income in 9 years. A company growing at 2% is doubling your income in 36 years. The growth rate is what you are buying when you buy a dividend growth stock, not the current yield. 4. Is the business growing? Dividends do not grow unless earnings grow. A company in a declining or commoditized industry paying a high current dividend, but with earnings under pressure, is on a path toward a payout ratio problem. Check the trend in earnings per share or free cash flow per share before trusting the dividend growth projection. 5. What account does it belong in? Canadian eligible dividends, which covers most major TSX dividend stocks, receive the dividend tax credit in non-registered accounts. This significantly reduces the effective tax rate on dividend income versus employment income or interest income. However, in a TFSA, tax treatment is already zero, regardless of dividend type, so the eligible dividend advantage disappears. In an RRSP, Canadian eligible dividends lose the tax credit and are taxed as ordinary income on withdrawal. Hold Canadian eligible dividend stocks in non-registered or TFSA accounts preferentially. The Canadian companies that score well on this screen in 2026. Fortis, 52 consecutive years. Approximately 73% payout. Utility, acceptable. Approximately 5% growth guidance. Royal Bank, multi-decade history. Approximately 47% payout. Consistent growth. Toromont, 14+ consecutive years. Approximately 32% payout. Approximately 11% 5-year growth. Enbridge, 31 consecutive years. Approximately 68% payout. Pipeline, acceptable. Approximately 3% recent growth. Canadian Natural Resources, 26 consecutive years, approximately 51% payout. $1.29 billion buybacks on top. The ones that fail the screen. Any stock where the payout ratio exceeds 90% without a clear regulatory justification. Any stock where dividends have been raised for fewer than 5 years and the yield is above 7%. Any stock where earnings have been declining for 2 or more consecutive years while the dividend has held steady, which means the payout ratio is climbing toward the danger zone. The 20-year comparison is definitive. On $10,000 over 20 years, a 4% yield growing at 6% annually produces $16,067 in annual income and a $159,241 portfolio. A 7% yield with no growth produces $3,688 in annual income and a $57,501 portfolio. The lower yield won by 4.4 times on income and 2.8 times on wealth. But the math is only half the lesson. The other half is the warning embedded in BCE's 2023 payout ratio. 119%, visible to anyone who looked, 8 months before the 57% dividend cut that cost Canadian income investors $510 per year in income from every $10,000 invested. Two numbers make the strategy work: the dividend growth rate, which is what you are actually buying, and the payout ratio, which tells you whether the growth is sustainable or a countdown. The 4% yield growing at 6% annually will be paying you 11.8% on your cost basis in 20 years. Fortis proved that. Royal Bank proved that. Toromont is proving it right now. The 7% yield with a 119% payout ratio was not income. It was a warning signal dressed up as yield. Now you know how to read the difference.